Oh my goodness, it's been a minute since we've done one of these, and happy to be back in the office today. If you're curious, we haven't recorded anything in a couple of weeks, as my wife and I welcomed our third born little girl, Juliet, 8 pounds 11 ounces on June 11th. So, you know, been here on the work front as much as I can. My team's been really great in kind of making sure things are good, but mom and baby are super healthy. Life's been awesome and chaotic. So, learning how to balance business, family, of course, faith, sleep, serving clients. So, translation here. Now that we're setting a routine, I'm excited to get back into these weekly market updates and kind of have more guests and kind of talk through things. But there's a lot of things that took place and just some things I'd like to share and what we've seen in this market. We had a really strong June. We're starting out with a very strong July in this market and with home buyers still buying homes. And the news is going to say otherwise. But candidly, we've talked about this in previous podcasts and recordings. We tend to see people in certain markets, reading what the news is going to say. Wall Street Journal published an article about a week and a half ago, and it basically just tarnished, I think, the idea of even purchasing a property for a lot of folks. And in some markets, we are seeing home prices come down. However, there are markets where there's still multiple offers. Candidly, we're going to talk about in a little bit. We have an offer in Oakland that just got ratified on a 10-day escrow because they kept getting beat out of offer after offer after offer. So we have them fully under in, have them set up. Essentially, what we've done is we're like, all right, cool, let's make a 10-day non-contingent offer. They're incredibly strong, and we knew this thing would fly. We had them fully under in. They got insurance the second they got into escrow. Appraisal's coming back tomorrow, right? So, I mean, these things happen. Now, let's talk about what's going on with interest rates before getting all that. So, mortgage interest rates have moved higher again. The reason why is we're seeing more things happen overseas. That's kind of what we saw starting March 7th, right, with Iran and the Strait of Hormuz. And we're starting to see these complications causing things to affect oil prices, right? We know that. That's the biggest concern. We saw that at the pump. We're also seeing grocery prices and things rise as well. Why? Because you're getting food that's shipped to you. I mean, that's how they do it. And it takes oil to man those ships, right? And the precious cargo, that's how they do it. So we're starting to see inflation go up a bit. The Fed didn't move, right? And so they're wondering, why did my mortgage rate go up? Well, the mortgage rates went up because of inflation. We talked about this before. I have recordings and I've done presentations. I even wrote a book on the Federal Reserve. If you want to check it out, you can find it on Amazon. But talking about the fact that we have a fiat currency, which is based off the US currency, which means the currency is strong as long as we don't print too much of it and as long as our economy is strong. And of course, with inflation, right? We want to look at inflation, making sure that inflation stays as calm as we can. So, you know, because it's inflation, it's very tightly close or close to what did I say in relation to your uh your treasuries. So if you look at a 10-year treasury note, that's a long-term bond. Mortgage-backed securities, a mortgage bond is similar. It's a bond. So inflation, which hurts treasuries, can also hurt the bond market and turn mortgage interest rates. Very simple, right? So now what we're seeing is, you know, rates going up because of the bond market, inflation expectations, what's been going on with inflation. You get a report that inflation's higher, of course, largely in part because of what's going on with oil. We see costs of living expenses going up and unable to meet that with consumer demand. We're seeing global events, these treasury yields, right? So it's not directly the Fed. So Iran, current headlines: renewed U.S. Iran conflict. We're seeing tanker attacks, Strait of Hormuz concerns, oil prices moving higher, investors worried about inflation. So this matters because 1/5 of the world's oil moves through the Strait of Hormuz. When markets fear disruptions, oil prices rise. And higher oil can feed into inflation expectations, right? So treasury yields move higher, mortgage rates tend to move higher. One simple explanation: oil goes up, gas goes up, shipping goes up, products cost more, inflation stays higher, mortgage rates move higher. This is why we watch world events as much as economic reports. This is why I do send a weekly digest, one that's geared towards folks that are in our industry, one that's geared towards clients, and then one that's just a brief executive summary, if you will, for financial advisors and CPAs that we work with. So what I'm watching next. So we're going to watch, of course, two inflation reports, right? We're going to look at PCE, which is personal consumption expenditure at the end of the month. We have CPI coming out next week. That's the consumer version, right? Which is not the most important report when it comes to the Fed. Candidly, PCE is more important than CPI. right? So when we look at CPI, yes, that's all over the news. Everybody's reading, the inflation report that comes from the CPI report. However, keep in mind that is a report that we get mid-month. The Fed looks at personal consumption and expenditure because they're looking at what the consumption actually is in the United States. That looks at GDP and things like that. So we also look at jobs reports. We have two major jobs reports that come out every month, ADP, and then we have the BLS. And then, of course, we look at Treasury yields and all. So these are things that will leave us there. And I'll be honest, I'm cautiously optimistic. I'm an optimist pessimist by nature, right? I don't want to see the good. I'm hoping, praying, looking to the Lord, like God help. But I'll be completely candid. Things can shift on a dime. And we've seen this. We've seen great swings. We can see treasuries drop 30 to 40 basis points, meaning you'll see an interest rate change. If you're looking at the mortgage-backed securities shift by 30 basis points, usually an eighth of a percent, do enough days of that, it could be a half a percent to full percent. We're just in February. We're a 30-year fixed rate and a conventional mortgage was around 5.5 to 5.75. FHA in the low 5% range. Now everything's in the low to mid 6% range. I do want to note, since we're talking about that, think about inflation that we had. When we had inflation with the previous administration and inflation numbers were high, we had interest rates 7 to 7.5%. So they're still better, and it's because these other things play a role, as I mentioned, job supports, right? What's going on with the strength of the economy? We're looking at personal consumption, these sorts of things, right? But still cautiously optimistic. I don't think rates will go above 7% again. I do think that, we do have hope for things to calm down, but keep in mind, if inflation continues easing and oil calms down, we'll see better mortgage pricing later this year. And it takes time. You plant a seed, you water it, it takes a little bit of time for that seed to start bearing fruit, right? Geopolitical tensions keep pushing oil higher. It becomes very difficult for rates to improve and even more difficult for them to improve quickly, obviously, right? So keep in mind. So the questions we're beginning, debt to income ratio. In the last couple of weeks, a lot of questions about that to income ratio. So it depends on the program, depends on credit, depends on reserves. It's not just one answer. What we want to look at is the amount of money that you are earning versus what you're spending. Now, you could be approved for a $2 million property, but you're only comfortable with a property, let's say 500,000, 700,000. We're going to look at that. We're going to examine that with you. Now, you'd be surprised. I actually, on social media, posted something even today as I record this. The differences between renting versus owning and how much home you could afford. It's funny because not a lot of people understand that. There is a correlation to that. There are some benefits. I'm not a tax advisor. I'm not a CPA, right? I don't work for irs.gov, right? But you can check out the irs.gov website and do your own research. There are tax benefits when you own a property, mortgage interest, property taxes, things to consider. So when you rent versus own, that's something to consider with that. So, one thing we're also seeing is non-QM with those that are like, hey, I'm self-employed. We had like a ton of these come up, or we are getting a ton of these coming up recently. They don't fit a conventional bubble. They're self-employed. They're 1099 independent contractors. So they file what we call Schedule C on their tax returns, which is what you do for a sole proprietor or self-employed for contract employee, right? You don't get a W-2. You do this. And they're like, gosh, but I do really well. I just write everything off. Yeah, they're using those expenses. So they're bank statement loans. There's asset depletion, there's profit and loss loans, right? If you're buying an investment property, you said property that qualify with rental income. We qualify those with rental income, should I say? The debt service ratio loan. I have presentations on this. You can check them on this channel on YouTube. But there's usually another path, right? Usually, as long as you qualify in other ways, credit, asset, right? So keep in mind with investment properties, we still get investors buying properties. DSCR loans are still alive. It's a great option. Jumbo pricing has actually been incredibly competitive lately. If you're buying a larger home, 2 to 3 million, as we see in this market where I am now in Laguna Niguel, you could see, jumbo rates actually in some cases being better than conventional pricing. So the crazy story on that is I'm speaking of jumbo, we do have a buyer in escrow back in the Bay Area. Great clients. We've been working with them for 6 or 7 months. I've had them as a client probably for a few years now. And then they just came back in the market, which is great. And we're excited for them because they finally got an escrow and they probably made offers on 30 some odd properties just trying to buy. And this market in the Bay Area is incredibly competitive. If you're in a desirable area, San Francisco, Oakland, Berkeley, Walnut Creek, the peninsula, it's incredibly competitive right now because there's a lot of tech money from AI coming in. And so they're getting bid out, bid out, bid out. So we got them fully underwritten. We wrote an escrow for 10 days. We just ratified it 2 days ago. And the buyer didn't tell us that she changed jobs. It's a big one because they're non-contingent. A contingency is basically where you protect your loan, and saying, okay, we're going to get a loan approval before you close. And if we can't get that loan approval, we could cancel and get our earnest money deposit back. Well, for a $2 million property, 3%, $60,000. So it's like, oh my gosh, what can we do to fix it? Because we love these clients. They're great, right? And they, with everything going on, the summer starting, they had a vacation in there as well. It just slipped her mind to tell us. So we found out, now we're in escrow. Everything changes because we have to make sure we get it documented. We're going to do fine. We're going to be fine with it. It's going to close. But we need to verify employment before funding. We need to make sure that you're gainfully employed. And as we talked about that income ratio, we want to make sure that we're looking at the amount of money that you earn, that it is likely to continue, that it is consistent. And so on that note, I want to say changing jobs isn't always a deal killer. However, keeping it a secret can tarnish things or make things a little bit more difficult. My word to anybody is just if you make a change, and if you're working with us and you're listening to us, great, let us know when you have a job change. If you're working with anybody else, if you have any job changes, any big purchases, anything like that, let your loan officer know. This is imperative. So 5 things I wanted to share with you, not to during escrow. Number one, don't quit your job or leave your job or resign from your job while you're actively looking to get an escrow on a property. Because we have to document it all. We have to show that there's, a job coming in to replace it. Either wait till you get in escrow and close, if you're thinking about making that move, right, is a way about, and we do want to make sure you have income because you have to have the ability to repay. So that's a big thing. So I'm not saying don't quit your job after you close escrow. Please don't do that either. But making sure that you're set up. Number two, don't finance furniture, appliances, anything like that. Don't buy a car. I saw a client who bought a car because they got in a car wreck and they're like, I got insurance out. They insured me for $20,000. That was my buyout. And so I used that as a down payment. And I got the sweet new Mercedes Benz. That was $80,000. Their auto loan payment was like $800 a month. Don't do that. That can affect your debt to income ratio. Don't move money around. And if you do, let us know about it, but don't open and close accounts because we need to still source those deposits. And then don't disappear, right? The good thing about this client, and we love her, she's great, and we're so excited for them that they're finally in escrow after how many offers they made, as we're touching base throughout the day, even in the evening after I put my daughters to bed. Infant was taking a nap before bedtime. We're emailing back and forth just to make sure that we came in this morning and get what we need, which we did. So it's working out. So if you're thinking about doing anything financially, the tip here is those things I just mentioned, call your lender first. So another thing I want to talk about is condos. So we talked about this previously. Condos are difficult to do these days. There's a lot of things that are going on in this market because of what's changed with Senate Bill 326, the laws thereof, making sure that, it's a safe property with ways to exit the property if there were to be emergency, like a fire or earthquake or things of that sort. So we dig into condos. Keep in mind, reserve studies. We want to make sure it's insured. We have to get the HOA questionnaire, which is something they complete. Now, Fannie and Freddie Mac, they have guidelines that they have to adhere to. And if it's already on what we call the blacklist with Fannie Mae, then you're stuck. Honestly, it's gonna be a difficult one to do unless if you could somehow get them to switch your mind, which becomes a longer and more tedious effort. So I want to talk about the exit here. It's called non-warrantable condos. You can do a non-warrantable condo, secure financing on that because it is basically not requiring the Fannie Mae requirements. There are still requirements to it, but it's an easy way to get through it. So what I want to share with you is we're seeing condos take longer because lenders are asking a lot of questions that they didn't require a few years ago. So sometimes it could go conventional, sometimes, with the Fannie Mae, Freddie Mac, sometimes it's even FHA approved. But, sometimes non-QM is the answer because it requires another strategy. So what I want to talk about and kind of wrapping this, if you will, or just before wrapping it, is this is really a good opportunity for home buyers. There's a lot of studies there, right? You saw the Wall Street Journal article. If you haven't, go Google it, saying how horrible a time it is to buy a house, X, Y, and Z. Well, rates are higher. Sure. Not as high as they were a couple years ago. Home prices are up. Yes, because there's demand for housing. So what I want you to think about is if you're looking to buy a property, just see what's available because it's more likely you will refinance and there's opportunity there. There's a lot of opportunities in this market. So you know, what I want you to think about is if you're able to buy a house and you're ready to buy a house, don't stay on the sidelines, right? Um, and there is something that we're still doing in this market. There's opportunities that we're still seeing, believe it or not. Refinance opportunities exist when those rates dip just a bit. We're seeing that, right, from where they were. Removing mortgage insurance, buying an investment property. We're seeing move up buyers. And then, of course, one thing we like to do to find these things is annual mortgage review. So if you have a mortgage and want to have a mortgage review, we'd be happy to have you and just do a call with you and kind of go over some scenarios with you or just game planning and what you should go for. If not right now, even a year from now. The best loans I've ever done usually came from people I've already helped, right? So one thing that, I want to share is, maintaining balance is everything. I have a new baby. God's blessed me with our third baby girl, and I'm beyond blessed and happy. There's business. What's so important is being present, considering others more worthy than yourselves, blessing them, being there. And remember that success is great, but that doesn't matter much if you never get home to enjoy it. So that's for those that work in our industry. You're watching this, if you're an agent or a lender, right? Now, if you got questions about interest rates, buying, refinancing, investment properties, or just whether or not want to know if now's the right time, reach out. I'm here. I love to hear from you. I want to help. That's kind of what I do. So reach out anytime. Wishing you all a blessed week and promise now that I'm back, we're going to do more of these. Talk soon.